Hello, everyone. Today I'm joined by Victoria Beasley from Gigascale Capital. Where are you dialing in from today, Victoria?
I'm dialing in from home in North Carolina after a decade on the West Coast. I'm delighted to be here. Thank you for having me, Julian.
No worries. We're excited to have you. I think this is going to be an absolutely awesome podcast. We've had VCs on the past from a lot of different sectors, and I think they always make for absolutely really scintillating shows because I think it helps people dive in both to the startup side of the world and also the investing side, which I think a lot of our students and listeners are quite interested in. Before we kind of dive into the meat of the show, could you please just, in simple terms, describe what is Gigascale and what your role is there?
Yeah, sure. So Gigascale, we are a venture firm that invests in early stage companies focused on climate change. And that can mean a lot of different sectors, and we can get into some of those. But at the end of the day, that's what we're all about. We focus early stage. And I would say beyond that, we really launched Gigascale with the idea that climate founders really need three things. They need a team that has a deep understanding of climate. I've been in the space for 15 years. We have that. We need a team that has some technical acumen. We have PhDs on our team and other mechanical engineers, electrical engineers, gives us an ability to characterize technical risk. And then we also believe and have on our team folks who have extreme operating excellence. The founding team, all of us were founders and operators. My colleague, Mike Schrefer, was a longtime CTO at Meta, for example. That's really what we're all about. An early stage team that brings together climate, ability to understand the technical, and then has real chops in terms of helping companies scale.
Awesome. I think it's a perfect segue to my next question because I think you highlighted that people who end up in the venture capital world can come from so many different backgrounds. So I'd be curious before we continue, what was your background and sort of like how did you find your way to Gigascale and what maybe drew you to working at the fund?
Yeah, such a great question. I've been in climate for over 15 years. I started my career in investment banking, but then pretty quickly was drawn to the operating side. So I was at a solar company back in the early days of solar. We helped get a technology out of the lab in Georgia Tech and scaled it domestically and internationally. We raised a couple $100 million of venture funding, which back then was a lot. And then this could be a whole other podcast in and of itself, but rode the solar coaster, as we affectionately call it, up and down and all around. But the point for me was that I really caught the bug. I loved being in the trenches with a team day in and day out, trying to do something that had never been done before in the world. And in particular, trying to deliver a new clean energy source. After several years in that, I made it out to the West Coast, went to business school at Stanford, started another company while I was there, which is also a whole other podcast. But as I was coming out of school and thinking about what was next, I often say I kind of got tricked into venture capital. My intention was to either start something again or go back on the operating side and join another team. One of my investors in the first startup was Gabriel Kra, who had kind of gotten Prelude Ventures, just getting Prelude Ventures off the ground. And his pitch to me was, why don't I come hang out there for 6 months and I can either start something new and they'll give me some capital, or I could meet a bunch of companies and then go join one. That sounded like a pretty great opportunity to me. Turns out I love the investing side too. Just an amazing experience at Prelude. I was there for 7 years, was a general partner, investing all in climate, but a very wide aperture within that. I wasn't looking to leave. I could have stayed there forever. That was the plan. I just had my second kid and was introduced to my now colleague, Mike Schrefer. And I would say it's a long story short, but really it was a pretty short story, which is the ability and opportunity to build something. I've always been a builder, was really appealing. And to get to do that alongside what started out as Mike, my other colleague, Evelyn, who I mentioned earlier, really just felt like a total privilege and opportunity for me to learn and grow in new ways. Yeah, we launched Gigascale about a year and a half ago, and it's been a great ride ever since.
Super exciting. And what's bringing that operator builder lens to VC, which is very interesting and cool. So one of the things that I know, sort of now turning the gear into talking about maybe some of the investments in areas that you guys are focused on, one of the unique aspects of Gigascale is the fact that you guys invest in hardware startups. Oftentimes people think of VC, it's investing in SaaS startups that have great economics, or at least on paper, that's what people believe. And the conventional thought is that hardware startups require much more capital, are maybe a lot slower to grow, are much more challenging businesses just from like the business standpoint. But this is one of your guys' core investment areas. So curious, what do you think is exciting about these startups and why do you think they represent good investment opportunities?
Yeah, it's a great question. It's one I get a lot. And I think it's a very reasonable question. And I also think we've sort of oriented and over-rotated towards our software orientation sort of in the investor world. So I'm happy to talk about it. First of all, there's massive economic opportunity in climate. Precise estimates vary depending on which model you look at, but trillions of dollars. Is it 1 trillion? Is it 10 trillion? We can debate that. But if I just take some examples, the global power market is close to $2 trillion. The chemicals market revenue a couple years ago was almost $6 trillion. The waste industry alone is $1 trillion. The cattle industry is $1 trillion. And I can go on and on. But first of all, climate is a lot of things. You're right to point out that hardware and sort of atoms represent a big piece of it. But I think sometimes in the conversation about capital intensity and time to exit, et cetera, we sort of get lost. We gloss over the fact that these are really massive economic opportunities. We are in I would say, the biggest transition since the Industrial Revolution in terms of industries across the spectrum needing to transform, needing to decarbonize. I think that's fundamentally the first premise we come to is there's a great economic opportunity. Now, we're in the business of impacting climate for the better. And at the end of the day, you can't do that if you're not willing to look at climate as an atoms problem. It's not just a bits problem, it's an atoms and watts problem. And we wouldn't be doing our jobs if we weren't investing in hardware. I think the other thing just to call out that's sort of changed over time, I think the old perception was that hardware is slow, it's expensive, it's too risky. And don't get me wrong, it's often harder to iterate or pivot when you're in the middle of a hardware scale up than it is to iterate a software product. But there are also a lot of things that have changed in the last 15 years. It used to take years to get to your first prototype. And now we have things like even just simulation and 3D printing and advanced computing that help that. Additionally, when some of the first wave of clean tech companies were trying to scale their businesses, they weren't just having to scale their integrated products, they were also having to scale the key parts of their supply chain that allowed them to put together the new machines that they were building. And now you look at things like the lithium ion battery supply chain, just as one obvious example, and you can buy those easily today at a very low cost. And again, the point is a good one and it's well taken. And I think the question's right. But I also think we need to continue updating our own models and perspectives and to accommodate the things that have changed.
Sure. That's a great answer. I guess the next follow-up question I have around this idea is there anything that maybe is different in the investing sense? Is there something that you look for in it differently in the founding team or in the market when you're investing in hardware versus investing in a software startup?
Sure. Great question. For any diligence process, we're evaluating the team, we're evaluating the market size, we're evaluating the technology, we're evaluating the timing of an opportunity. That is true whether it's a software opportunity, that's true if it's a hardware opportunity. Every diligence process is a little bit different, but I would say the frame that we take is every company is going to have a risk to it. Some have more. The question is how many risks are stacked on top, and do we think the potential outcome is worth that risk? Again, I would point you to, and maybe this will come up later, but I think sometimes the question behind this question can sometimes be, how do you think about exit horizons, for example? And this is another place where, candidly, I just think there's been a lot of sort of a misinformed view that hardware companies take much longer to exit than software companies. And when you actually look at the data, there's really not that much difference. Depending on, again, where you cut the start and end points, I think a fair representation is 7 to 10 years as a median for both. And yes, sometimes software cohorts can be on the shorter end and sometimes hardware cohorts can be at the longer end. But if I just look, for example, since 2020, median time to exit in climate companies is 9 years. And that's not meaningfully different than software companies. So hopefully it gives you a sense.
Since we're on the topic of the exits, do the exits look any different in your mind, or is it a mix of IPO, exits to strategics, or?
It's still generally a mix. Yeah. I mean, in the last decade, oil and gas majors have been an active acquirer, but that's mostly within the energy and transportation or mobility sectors. If you go outside those, which again, climate is so many things that I think we have to think very broadly about what is climate, the exits are across the board. So yeah, it's again, not that different from sort of mainstream or software investing in exits.
Are there any particular sectors within hardware that you're most excited about looking at 2024 and beyond?
Oh man. Okay. How long do we have? I'll give you two that we're interested in right now, and I'll try to give you kind of one on each end of the kind of moonshot spectrum, if you will. On the one side, maybe starting with the moonshot side, we are taking a renewed look at all forms of fossil-free baseload power. And I'll try not to get too jargony here, so let me just unpack that a little bit. There are different forms of source of power on our electrical grid. Some are assets that get turned on and off as the demand gets really high. Others are variable, solar and wind. Solar is not producing when the sun doesn't shine, and wind is not producing, wind is not blowing. And then there are other historically fossil-based energy assets that sort of run the same no matter what, concept of baseload. we are huge proponents of solar and wind and a number of other intermittent sources, but we also believe that there are probably other opportunities to get us to cheap, reliable, fossil-free electricity across the board. And we are open to the quote crazy ideas. We pride ourselves on being very first principles based, and we don't want to be breaking laws of physics or chemistry, but outside of that, we're very interested in how do we accelerate our transition to baseload power. I'll just make another point on that before I give the other example, which is that type of electricity is also the unlock for so many other essential climate technologies, whether it's electrification of transportation or electrification of chemical production or chemical separations, and the list kind of goes on from there. But we really believe that we need to continue making progress towards a fossil-free power grid. On the other end of the spectrum, we also get excited about companies that are enabling the deployment of known technologies. One example here is the heat pump. Despite having a confusing name, it needs a marketing upgrade. These are world-changing devices, and our belief is that the technology around heat pumps is actually good enough. It's other challenges that are preventing the deployment. It's how do we train and incentivize HVAC contractors to learn about and know how to install these devices, and sort of other things that are blocking and tackling to getting some of these technologies out. Another great example of this is upgrading existing infrastructure. You can use advanced conductors or devices on the transmission lines that we have on the grid. The estimates are that you could quadruple transmission capacity by 2035 just by using those advanced technologies on the existing grid, which allows for all sorts of things, including enabling further penetration of renewables. So those are a couple examples. One, moonshot side, how do we get new forms of fossil-free baseload power? And on the other side, how do we take what we have and take off some of the blocks that are preventing massive adoption?
Totally. I want to shift gears now a bit and talk about maybe as part of your due diligence process, I imagine there's some sort of impact requirement or impact diligence that you guys do as a team to understand what climate impact is the startup having beyond their pure financial reward. How do you may build a criteria set to determine, okay, this startup meets our threshold of impact? Is that a pure hard threshold that you guys have written in stone, or is it more a little bit loose depending on maybe the industry or the sector that the particular startup operates within?
Yeah, you'll find a range of opinions on this. I would say my philosophy is actually pretty simple. The thing I tell my team is I don't want to have to squint at the climate impact. Now, over the years, I've toyed with specific figures, number of gigaturns avoided, et cetera. But at the end of the day, I found that I'd rather not try to be falsely precise and instead focus on, does this business have a meaningful shot at getting to scale? And if they do, can they have a meaningful impact on climate? I think at the end of the day, yes, we definitely do back of the envelope calculations to make sure that we're not having to squint. And where there are cases that are on the edge, we have rigorous debate and we dig more into the details and try to put towards more of a number. But I think sometimes this gets more complicated than it needs to. And so I go back to where I started, which is I don't want to have to squint at it. I want to feel proud and confident that with success, this company is going to have a massive climate impact. The other thing I would say, which is sort of the point underlying that, is it's hard to build a business. It's hard to start it. It's hard to scale it. And the last thing we would want is for a founding team to have to try to contort themselves to meet a certain climate metric when that may not be the best thing for the business. So long as we have collinearity between business outcome and climate outcome, we'd rather than focus, after we check the box on climate, we'd rather than focus on building a great business rather than trying to count the actual tons avoided.
Sure. I guess a follow-up question that's slightly philosophical on the concept of impact requirements when it comes to climate investing is there are companies in your portfolio such as Pasture Biosciences that operates within the livestock industry or cattle, which is an historically polluting sector within agriculture, and agriculture itself is obviously a fairly large emitter of carbon emissions in the world. And some people would say that we shouldn't have cattle altogether, that it would be more sort of like climate friendly for everybody to be eating vegetables and get majority of their sort of nutrition from not meat sources. Pasture is still is obviously making the livestock industry more clean and less carbon intensive, or I guess in this case, methane intensive, so less greenhouse gas intensive. Mm-hmm. I guess, is that enough for you? I guess obviously it is in this case because you made the investment, but what would be your pushback to somebody who would say perhaps we should only be investing in areas that sort of move the needle forward in industries that are net cleaner across the board, the best option for that?
I really respect those points of view. And I've certainly, over the course of my career, debated where I spend my time, debated where I invest the dollars. I think at the end of the day, I'm a pragmatist because I think that's what moves things forward. And sure, we could say we're just not going to invest it all in cattle. That's not going to change whether cattle are being grown and eaten around the world. It's just not. I'd rather be, and we would rather be part of the solution to help take emissions out of those large sectors than to just say we're just not going to invest in it. The same could be said for aviation. The same could be said for pick your sector. But I think our philosophy is one of pragmatism. And again, I go back to my philosophy is that the only way we're going to solve climate, we live in a capitalist society that has ills, that has extreme benefits. And in my personal belief, and I think Gigascale would hear this, we're not going to get to a climate solution if we don't get solutions to scale. And I think that's the thing that we try to focus on rather than getting tied up in the inbounds, out of bounds.
Sure. That's a great answer. So you mentioned at the beginning of the call that, Gigascale, one of the reasons that you were attracted to the fund is sort of the three pillars that you guys provide in terms of like who represents the makeup of the fund. And VC is notoriously difficult from the sales side, if you could call it that, because at the end of the day, your product is selling money. And so what value do you think do you provide to founders that allows you to win deals beyond just sort of the dollars and cents of the actual investment that goes into the company?
Yeah. Let me sort of reframe what I mentioned earlier and take it a couple steps deeper. We really have three core pillars. One, we understand climate. Why does that matter to a founder and how does that differentiate us? We've been around for a long time. So not only do we understand the alphabet soup, but we've also seen extreme ups and extreme downs in this space. We've seen policy changes. We've seen industrial policy shifts. We've seen a lot of things change, and it doesn't scare us. If anything, we're sort of double committed. What does it mean to have technical acumen on our team? What does that mean to founders? It means that if somebody is starting a new company, electrochemistry, Evelyn and others on our team can hop on the phone and whiteboard with them various techno-economic decisions from a place of first principles understanding. And then the third is that for our founding team, we are all founders and we've all been operators. The clearest personification of that on our team is Mike Schepfer, who, when he stepped down from his full-time role at Meta, had 35,000 people reporting up to him, starting from a few hundred when he started. That matters in terms of how we can serve founders. One bar that we hold ourselves to of success and seeing if we are actually differentiating is whether you could call any of the founders listed on our portfolio page and would they tell you that we're the most helpful, irrespective of what, to your point, undifferentiated cash we've given them. And I think the stories you will hear is that we are extremely helpful. It's not always in ways that you might think. Certainly, we love to be a strategic partner, and certainly we love to help them see around corners. But we also, I think, bring our experience to bear in really practical terms that, as we often say, help our founders go further or faster. Examples of that can be as simple as a founder's just raised a bunch of money and they give me a call and they're like, hey, Victoria, I just need to ask you this question. I don't think I can ask anybody else because it seems kind of silly, but I don't want to spend 3 hours looking for the answer. I just raised a bunch of money. Where do I put it? What sort of bank account do I use? Do I use a money market account? Things like that, all the way to, hey, Mike, we need to go through a CTO transition, or we have a big organizational shift that we need to get through. How do I message that to my team in a way that keeps them motivated and excited? The list goes on, but the point is we as founders ourselves really empathize with, I think, and try to do our best to deliver value where it matters to founders. And also, equally as important, stay out of their way where we're not useful. Many more stories I could give on that, but that's sort of our ethos.
Sure. And I now kind of want to turn the question around, and you're probably particularly well suited to answer this given your background, is are there maybe things that founders of climate startups look for that's different in their venture funds that invest in the company? Is it maybe just purely their climate knowledge, or are there other things that you think are quite important for those founders when they're evaluating which funds they want to take investment from?
Yeah, it's the flip side of the same coin. I reflect back when I was in solar in the early days, and we jokingly refer to it as the solar coaster, but it really was. We had, you name it, we dealt with the challenge. There were raw material price spikes. There was a trade war. There was a metals price spike. There was funding that dried up. I could go on and on with the curveballs we were thrown. And I know how much I benefited from investors on our board and on our cap table who were clear-eyed about the realities we face, but also had sort of steady hands to guide us through those challenges. I think, how do you quantify that and how do you exactly label it? It's hard to say, but I think founders, maybe even more so in climate, I think they appreciate folks who have that perspective.
Sure. And now, how did you as like a VC develop your bar of what a good founder is? I realized this summer when I was picking startups to go work for that it's quite challenging over a 30-minute, an hour-long call to sort of evaluate their potential and the ambition of the company. So curious to how, is it just reps of seeing so many people that eventually you kind of figure it out? Or is there any other tips and tools that you have that you think help you develop that bar?
Yeah, it's a great question. I don't know if I have anything particularly original to add here, but I do think a big part of it is just a lot of reps. And it's not just going into the pitch, but one thing I tried to do earlier in my career, and I encourage others to do, is come to a quick conclusion. Sure, as you do more diligence, you're going to learn more things. But even when you first hear a pitch, try to come to a conclusion of, what do I have to believe for this to be an exciting opportunity? Certainly the team component, which I think is mostly what you're asking, conjures questions of, do they have a fast learning rate? That's something we talk a lot about and we try to measure. Are they willing to experiment? Are they more likely to plan for a long time in a really kind of protracted but thoughtful way? Or are they more oriented towards quick experimentation and rapid iteration? I'd say we very clearly fall towards the latter in terms of what we look for in founders. I think outside of trying to develop the muscle by encouraging ourselves to build a perspective, and outside of seeing lots of founders, besides that, we used to do an exercise at my prior fund of trying to every year estimate which companies were going to be the winners. And we spend a lot of time really thoughtful about, what do we know, what has been de-risked, what's still left to be de-risked, how much capital do they need to raise, long list of criteria. And when we did sort of a meta-analysis of that exercise year over year, the reality was, and this is not just in climate, but the reality was we were not great at predicting sort of the precision of who was going to win and on what timeline. And part of the reason for that is there are so many externalities that you cannot expect as a founder. I think seeing founders operate over time and seeing who has the resilience, who has the flexibility, who has the stick-to-itness, who has the willingness to integrate feedback, I think is, the longer I've been in it, the more important those qualities become. And some of those you can see on the front end, some of those you learn by working alongside each other.
Great. And now the next question that I want to ask is maybe a little bit external to Gigascale, but curious for your thoughts on it. The last 18 to 24 months have definitely been a very different venture investing landscape than maybe it was in the past when we think about interest rates and sort of the timelines that investors want their money back and maybe some of the funding challenges associated within the industry, which probably maybe impact hardware-related startups slightly more given maybe they need more capital, but we can maybe debate that. Curious though for your thoughts of whether you think this is a healthy thing for the industry in terms of now we're going to get maybe a crop of startups who are going to be much leaner and much more efficient because now they're no longer in this bloated funding environment where they get these huge rounds, or is it really going to be maybe a slowdown on development within the industry because people aren't getting the capital that they really need to grow and develop?
Yeah, we've talked a lot about this internally. Certainly interest rates affect cost of capital. Of course, that is true. There's no denying that. But I think I'd actually make two other points, which I think sometimes get conflated with the sort of interest rate environment we've been in. First of all, we had a period of very inflated valuations relative to risk that was left in many startups. And I think as investors, we were trying to counsel founders to have a long horizon view and to not get too oriented towards near-term dilution targets. But I think part of what we're seeing now, irrespective of the interest rate environment, is the next funding round that is coming after those very high valuation rounds. That's one point. I think the other point I would make is there's still a lot of capital out there. And if there was a growth investor sitting beside me, they would be saying emphatically, we're ready to write checks. We're just not going to write checks into companies that have negative margins and are not growing. I think what that means, what that equates to, is that there's been a flight to quality. So for companies that are executing well, they are definitely getting funded at very attractive valuations. There is capital available. So I think we're in this normal, it happens, it's a cycle, but we're in this period of the cycle where there's some reconciliation happening from what I would argue it was, and many would, a sort of inflated period of time a couple years ago.
Great. And now I want to move into sort of the last part of our podcast, which is very much advice related, given that we are a business school podcast. And the first question that I have is, venture capital is on one hand notoriously difficult to break into, but as I think you alluded to in the beginning, there are multiple paths to get into it. And I think that's almost an exciting thing and a hopeful thing for a lot of people, but maybe is also in itself represents a challenge of what is the right path to take to get in there. Curious whether you have any sort of like advice about breaking into the VC industry. And if you're in business school today, what would be the best path for you to pursue?
Yeah, you're right. There are lots of paths in. I will pick two, and I'll try to be super pragmatic, as is my style, and even tactical. Two thoughts. One, go work for a startup. And it doesn't have to be a 2-person startup. Sure. Will I always encourage people who have an interest in founding a company to go do that? Absolutely. But I think there are lots of different ways to get into the venture community, the early stage investing and just growth stage companies even. The other point I often make when I'm talking to students is not only do you not need to go work at the 2-person or 5-person company, but I think sometimes there's a false bifurcation that happens amongst business school groups of, hey, I'm either going to go super, super early stage or I'm going to go to this really established company and I'm going to learn scale. I'm biased, but I think there's a lot of learning that happens in what can sometimes be the messy middle. I think the screen is, can you go somewhere? Can you find somewhere where there are more opportunities than people so that you can raise your hand for something that you find interesting or you find would be impactful to the business and be able to do that because there just aren't enough resources around. So go work for a startup. Don't overlook the kind of Series A, Series B, Series C companies that maybe have early product market fit, but still have a lot of work to do. The second idea is you can angel invest with not very much capital. This is something I didn't really appreciate even when I was in business school, but you are surrounded by really impressive founders in your class, the class above you and the class below you and the broader Wharton community. And there are opportunities for you to start building your own track record just by blending some time and a little bit of capital. Easier, lower bar, lower threshold ways to get started.
Awesome. I think those are two great pieces of advice. And I guess the final question that I have for you is slightly more meta, perhaps, is what's the best piece of advice that you received, either VC or non-VC related, can be about anything?
Yeah. Oh, man. Okay. Non-VC related, I think 2 personal ones. One was to go on another date with my now husband. So that worked out great. Hard to ignore that one. The other, my dad used to always say you can never have too many friends. And I think that can apply in all sorts of ways in life. And then on the venture side, I think particularly when folks are early in their career, this was some advice that was given to me and it's really stuck with me, which is challenge yourself to push for the investments where you have conviction and not just the investments that you think you can get done. And sometimes those are the same thing, but sometimes they are not. And I think sometimes the contrarian bets or the outlier views or investments where you can't get consensus end up being the best ones. And I think it's tempting and tricky, particularly when you're still learning the ropes, to navigate that dichotomy.
Awesome. Well, thank you so much for joining the show today, Victoria. I absolutely loved it, and I'm sure the listeners will too. So thank you so much again
Julian.
for the entire Wharton community.
Really appreciate the opportunity to be on. Thanks for everything you guys are doing.